Welcome to a new video. Moat is a term that gets thrown around quite a lot these days. Everyone knows that a moat is supposed to be a competitive advantage. But when you spend a little bit of time online doing some research on a company and reading business analysis, it seems that anything positive about a business can be twisted and represented as a competitive advantage of some sorts. So in the first part of today's video, we'll be reviewing what exactly is a moat and why are moats important. Then for the majority of this video, we'll go over some of the most common mistaken moats, that is, business characteristics that are often cited as moats, but in reality just ain't so. Make sure to like the video and subscribe if you like this type of content. And if this video gets enough traction, I'll make follow-up videos about examples of actual moats. And without further ado, let's dive right into it. To answer what a moat is, it first helps to answer what is the purpose of a business. The purpose of a business is to take in capital, reinvest it into goods or services, and from that to generate more capital than was invested in the first place. But that's a good business. Not all businesses can do this. A lot of businesses actually generate less cash than they take in, and those are bad businesses that, as investors, we're trying to avoid. We live in a capitalist system that encourages competition. Let's take the epitome of a small business, the lemonade stand. Let's say that this lemonade stand takes in $1 in lemons and manages to sell the lemonade for $1,000. That doesn't sound very realistic, I know, but just go with it for a second. Everybody would look at this lemonade stand and say, what the heck? How is this kid making that much money? And people would study exactly what this kid is doing and try to mimic it, to replicate those returns. Who wouldn't want $1,000 for just $1 invested? So more lemonade stands would open on the street, and all of a sudden, you would get 100 lemonade stands in the same street. And that could lead to two things. First, you're saturating the market, so everyone on that street now has 100 different stands to pick from. And two, the price of lemons would probably go up because now everyone wants to have enough lemons to make the lemonade, and you would end up having to pay more to acquire those lemons. And the result of all this is that the returns would go down for everyone. The more entrants, the more the returns tend towards zero. And eventually, you get some sort of an equilibrium where the pace of new entrants is equal to the amount of people leaving the business due to poor results. That's something called a commoditized market, or a market with little to no barriers to entry. Most markets and most companies have returns that end up reverting to the mean. That means that companies with high returns see them decline over time as new competitors move in, and companies with low returns see them improving over time as their competitors go out of business. A moat is exactly that. It's a business characteristic that acts as a barrier to entry. If this lemonade stand had a moat, it means that no matter how much people study it and try to mimic it, it would be extremely difficult, dare I say impossible, to replicate it and to eat into those returns. And the result is that this lemonade stand ends up having very high returns over a very long time. So why are moats important? If businesses that have moats are able to generate above average returns that are durable, then surely those businesses must be more valuable than businesses that do not have moats. It's common sense, really. Think about your everyday life. You're probably going to pay more for a pair of jeans that will last you 10 years versus a pair of khakis that will start getting holes within 6 months. Same thing in investing. If an asset can produce excess cash flows over 20 years because it's protected by a moat, then I should be willing to pay a premium for it over another asset that is currently producing cash flows, but that is not protected from competition. If you've seen a few videos on this channel, you know that we prioritize a long-term perspective when investing. If you're trying to implement a strategy of investing in companies that will be able to compound your capital year after year, decade after decade, then you need to be able to identify companies that are protected by moats. That's the reason why moat is one of the three main components that define the quality ratings on Rated A. Okay, now that we're all up to date and that we've covered the basics, let's get to these fake moats that are often mentioned by analysts, but that really fail to protect a business over the long run. The first one on the list is first mover's advantage. So, this refers to when a company is the first one to introduce a new product or a new technology or to create a new market. And usually, when a company is first, it ends up having good brand recognition. And of course, it ends up having lots of market share, especially at the beginning. And people often wrongly believe that this short lead at the start is enough to propel the company forward for many years ahead. Obviously, this is not a given. Many times, a company that is the first to create a new market or the first to introduce a new technology has an advantage that's temporary. And in fact, entrants that get into the market later on might actually have an advantage over the incumbent. Why is that? Well, they can learn from the first business's mistakes. They can see what went right, what went wrong. They can study the market. And as a result, they can enter the scene with a strategy that is more clear. They can use the insights that are found by the first company and improve upon them. And because new entrants are usually smaller and more flexible, they're often able to introduce a better product at lower prices due to more efficient operations. Let me take you through a couple of examples to illustrate this point. MySpace was a very early leader in the social network scene. It was very popular and lots of people were on the platform until the mid 2000s. And then Facebook entered the chat. And Facebook figured out how to offer a more user friendly experience, better customization, and MySpace ended up declining into irrelevance. Another example is Yahoo. Yahoo was one of the first movers in the online search engine space, and it was super dominant early on. The stock was going up like crazy, everyone was hyped about it. But then Google entered the scene, and they had a better product with a better algorithm, and they also figured out how to monetize their product better. And now Yahoo is just a shadow of its former self. And now let's have a look at BlackBerry. BlackBerry was one of the first smartphones to exist. It was super popular among business users. It had secure email capabilities. There was BBM that was very, very popular. But soon enough, Apple figured out how to give users a better experience with the iPhone. So did Google with their Android smartphones. Both Apple and Google figured out how to give users a better experience, more customization, and overall a better app ecosystem with more possibilities. Blockbuster is another example. Blockbuster was very dominant in the video rental industry, and then on came Netflix. Netflix first offered DVD rentals by mail, but then pivoted to streaming. Blockbuster saw all of this coming, but the company wasn't able to pivot soon enough because it didn't want to cannibalize its own business. I can also find some examples today of companies that are considered to be first movers. The story hasn't played out yet for them, but I think a word of caution is advised at this point. Let's have a look at Tesla. Tesla is considered to be a pioneer in the EV market. It was given subsidies by the government to be the first one to manage to do this at a large scale. But eventually, the big boys like Ford and GM, and even a company called BYD in China, figured out how to do the same thing and maybe in a cheaper way. I think there's a chance that within the next 5-10 years, Tesla will have some trouble keeping their leadership position in the EV market. The second fake moat on my list today is great management. Let me be clear. That is not to say that a good management team has no impact on business success. All things being equal, it is much better to have a capable management team at the helm of any business rather than a bunch of incompetence. I would even go so far as to say that most businesses that end up performing well over 5 to 10 years are usually run by some extremely competent people, without which those same results would not have been obtained. But there are a few problems with this idea of management being a moat. And the first is that just because one company has a great management doesn't mean that one of the competitors can't also have great management. Also, management capability is hard to measure. Well, let me rephrase. Management capability is hard to predict. As investors, we want to know more about the sustainability of a company's performance and how far in the future they can keep performing like this. But figuring out that a management team is good is easier done by looking back at previous performance. What return on invested capital did they achieve? How much debt did they take on? What was the change of market share during their tenure? It is much harder to figure out how a management team will do looking into the future. And finally, there's the fact that management teams experience a relatively high turnover. A CEO might be at a company for 3 to 5 years, and that's a decent time of tenure. How can you make long term investment decisions based on management when you can't even be sure that the same team will be with the company 3 years down the road? My experience is that on average, you'll be much better off by focusing on the quality of the company rather than the management. When it comes to a horse race, it might make sense to bet on the jockey. Most horses at the event will have been bred and trained to run fast. So the level between the fastest and the slowest horse won't be that far off. But in the business world, race horses end up racing against mules and ponies. And even the best jockey in the world won't win the race if they're on the pony. So here are some real world examples that I could find. The first comes from General Electric, or GE, under Jack Welch and Jeff Immelt. At the end of the 20th century, Jack Welch was celebrated as one of the best CEOs of all time. There were books written about him. He had turned GE in 20 years into a diversified conglomerate and a profit generating machine. But some of the strategies that he used, like aggressive cost cutting and focusing on financial services, ended up being challenges for his successor. And by taking a long term view of the stock, we can see what the result was for shareholders. Another example is Jeff Skilling at Enron. Skilling was considered super intelligent, and his approach to energy trading was considered revolutionary. But little did we know, he was at the head of widespread misuse of accounting fraud to generate those really high returns. Enron collapsed in 2001, the stock went to zero, and Skilling was convicted of several federal felony charges. Enron had no moat in energy trading, but the CEO was a genius. And what about Steve Jobs at Apple? When he came back to Apple after being laid off a few years before due to his inadequate management style, who could have known what the future held? And finally, the one I've been burned by myself is Pat Gelsinger at Intel. This man came back into Intel as a savior to turn the ship around. In 2021, when the company was struggling with competitors taking back the technological lead. Gelsinger was a tech executive with good experience and an engineering background. He had spent 30 years at Intel earlier in his career. He had previously already been the CTO of Intel, and he had a clear vision of how to restore Intel to the semiconductor lead. But no matter how great he is, 3 years later, and Intel so far has been too much dead weight for him to carry. I've invested in Intel in the past, and for those who are interested, I'll have a video out soon to detail where I went wrong in my investment thesis and the overall lessons I'll take with me from this mistake. Third on the list here of fake moats is having a great product, also known as having better technology. It's not going to be hard to explain this one. Actually, I can explain it in 2 words: easily copied. Unless the product or the technology or the manufacturing process is patented, it's pretty much impossible to keep competition out simply by doing things better. And even when that thing is patented, you can be damn sure that everyone will be trying to break that patent, finding loopholes in the text, or looking for workarounds to come to get a similar end result. Let's go through some examples of companies that had great products, but that eventually were caught up by competition. The first here on the list is GoPro. GoPro invented the tiny little camera that you can carry around everywhere, that you can wear on yourself and film everything in point of view, which means that you can get some sick shots when you're surfing or mountain biking or those things. As soon as GoPro became successful, many companies, including Sony and Xiaomi and others, began producing similar action cameras. And often, these cameras were at lower price points, which ended up diluting GoPro's market share. Another similar example is Fitbit. Fitbit invented wearable fitness trackers. By wearing Fitbits, people were able to monitor their steps, their heart rate, and other health metrics. Seeing that this was a popular market, big companies with large resources like Apple, Garmin, and Samsung eventually ended up developing their own wearable fitness devices. These devices had more advanced features, and eventually they knocked Fitbit from the top spot. Okay, I've got one more for you. Let's talk about Snapchat. Remember when Snapchat came up with the stories concept? And everybody was using it because it allowed people to share little parts of their lives with friends. And these ended up disappearing. So you had to be on to be able to see what your friends were doing all the time. This was brilliant. And it was super popular among younger users. It only took a few years for Facebook through Instagram to adopt the same concept. They literally didn't change the name. It's called Instagram Stories. And it became a super massive success and propelled Instagram to another level. On a similar note to the previous fake moat, we have what analysts like to call operational efficiency or great execution. Let me tell you one thing. If a company has to be super efficient, super lean and mean in order to do better than the competition, then that means that the company probably operates in a very tough industry where the only way to do well is to be lean and mean. Which businesses need to be efficient? It's the ones that operate in commodity industries, for example. If you're an oil refiner and you can't produce at a cost that is at or below the price that's established by the futures market, then your business will fail and eventually disappear. Same goes for companies that do have differentiated products, but that operate in industries with no barriers to entry. Can you own a restaurant and not be efficient? Can you own a coffee shop or a hotel or a car manufacturing business or an airline or a pharmaceutical generics business without being efficient? Empirical evidence says that no. And look at some of the highest quality companies in the world with the largest moats. Companies like Alphabet, Meta, and Salesforce. These companies are renowned to waste lots of capital on celebrities or ego projects and extravagant offices, but these companies can afford to waste capital, so to speak, because they have real moats. And efficiency can also be copied. There's a really good book called Seven Powers by Hamilton Helmer, where he goes through what he thinks are the seven moats that companies can possess. One of them is counterpositioning, which refers to when a business adopts a new, superior business model that the incumbents just can't copy because it would cannibalize their existing business. An example we already covered would be Netflix and Blockbuster. Counterpositioning, just like being more efficient, is a tactic that can temporarily boost business profits. But the business landscape is a continuum. If a new entrant manages to dislodge an incumbent because of a superior business model or better efficiency, future new entrants will take note and use the same tactics as the new incumbent. For example, Ryanair was one of the first companies to challenge the legacy airlines by offering cheap flights in Europe. They were able to offer such good prices because they offer a bare boned experience. I mean, you even have to pay to get water on Ryanair flights. But now you fast forward a decade, and there's a plethora of cheap fare airlines in Europe that are all competing with Ryanair for the same customers. Guys, I've got an announcement to make. We just launched a Discord server for members of Rated A. You can find it by clicking on the community tab right here in the inner menu. You'll be able to speak with me directly about investment ideas and overall market events. And you can even vote on which companies get added to the platform next. So far, we have ratings on around 30 companies with a full mode analysis for each of them, as well as a profitability and a safety analysis. And you also get a super neat view of the company's important financial metrics like the free cash flow per share, which takes into account stock based compensation, the return on invested capital, the interest coverage, the company's free cash flow multiple history, and much more. You can get access to all of this for only $5 a month. That's the price of one coffee. And I can guarantee you that it'll bring you a lot more long term value than that. Alright, that's it for this video. I'll see you in the next one.